and it will likely be the worst downturn in the post-World War II era, so worse than 2008 and 9. It will unwind, I think, rather rapidly. Could see a 70 or 80% decline happen in 6 months or less.
Hey everyone, this is Elijah K. Johnson with the Miles Franklin Market Update. And with us today is David Hunter, a contrarian macro strategist with 40 plus years experience on Wall Street. David, thank you so much for joining us today.
Yeah, thanks, Elijah. Thanks for having me.
You said recently that you see the stock market rallying further, the Dow getting up to about 36,000 and then shortly after crashing. So can you expand on this? Why do you see the stock market rallying and then crashing? You've called for about an 80% crash.
Yeah, let me step back a little bit. This is all in the context of, I think we are in the latter stages of a secular bull market. And I date that secular bull market back to August of 1982. Back then, the Dow was 880, and now it's obviously over 30,000. So that's how far we've come in 38 years. And I think we're in the latter stages, what I expect to be ultimately the final parabolic stage of that bull market. So that's kind of the context of where this rally comes from. I think it will get steeper and steeper as we move through this month and into January. Could carry beyond that, but I think it has potential here, depending on how fast it gets going, to be the next month or two. And then beyond that, I think we are dealing with what I have talked about for several years, a global deflationary bust. So it's not just US centric, it's really around the world. And as I say to people, I believe that bust really began in March. Obviously, several years ago, I had no idea the pandemic was going to trigger it, but I think it did trigger it. And my view is now we had obviously tremendous monetary and fiscal response to that hit in March, and it gave us a couple quarters of rebound. I think following this rebound, whether it's 3 quarters or whatever, we have what I call a second shoe dropping on that bust. And it will be a global downturn that includes deflation. We haven't had a widespread deflation since the 1930s, since the Great Depression. So this will be the first deflationary downturn, and it will likely be the worst downturn in the post-World War II era, so worse than 2008 and 9. Given the leverage in the system, I believe that can happen very quickly. So it's not going to be, I should step back again and say I define a bust as something that's in many respects the magnitude of a depression, but happened in the speed of a recession. So I think it probably is contained mostly within a 12-month time horizon. So that's what I think will trigger what you're calling a crash. I call a big bear market. It will unwind, I think, rather rapidly. Could see a 70 or 80% decline happen in 6 months or less. May stretch out longer than that, but I think it has the potential to happen that quickly.
If we see the stock market declining by 70 or 80%, that would put the Dow around 6,000 or 7,000, about where it was at its low in 2009. So that's really where you see the stock market falling.
Yeah, I tend to focus more on the S&P. So for me, just numbers wise, if we can get to 4,500 on the S&P here in this final parabolic move, an 80% decline would take you back to 1,000 on the S&P. So that's kind of what I see. And if the Dow works out that way, it's pretty much your number is probably right. And I think that's because of the leverage in the system. And leverage is not just the debt. We've got $250 trillion of debt on the global system. We've also got quadrillions in notional value of derivatives. So we've never been here before in terms of the leverage that's in the system. The derivatives can move markets around pretty fast and exacerbate whatever would have happened otherwise. And we have never in the history of the world ever been anywhere near this level of leverage. So that's, I think, once an unwind begins, it can happen very steeply, very quickly.
Do you see that the Fed or the government could somehow step in and prevent such a crash?
No, again, anything theoretically is possible, but history tells you that our government and our central banks respond to crisis. They don't anticipate them. They anticipate to an extent and try to work around, but ultimately when something like this happens, you can go back to any of our recessions, any of our bear markets. They're much better at reacting to the crisis than heading it off. So even, go back to March, you don't have to go back very far. Even with the pandemic and maybe some evidence in February that something was coming that wasn't going to be pretty, they still didn't at all prepare ahead of it. They really reacted to it. They reacted in for them, a very swift way and in a very major way. But really, again, it was a reaction rather than an anticipation. So that's kind of their MO. Governments you have to build consensus, as we're seeing with stimulus, the most recent relief package. It's not easy to build a consensus today. So that slows everything down. Central banks can move faster than that, but there's still a consensus building body. And so, you've got to deliberate and they're also, a lot of their work is based on data that is just by definition backward looking. So, as much as they want to be forward looking, most of the time they're looking at data that's based on something that's just happened. So all of that kind of means you'll see a response rather than an anticipation.
In the years ahead, you also see high inflation coming. So how does that fit in if we're seeing kind of, as you mentioned, kind of a deflationary environment, a significant correction crash in the stock market? How does inflation fit into all of this?
Great question. I'm already saying that the deflation we're going to have is the first in probably 80 or 90 years, going back to the 1930s. So to say we're going to have that and then to follow that with inflation when what we've had for the last 38, 39 years is disinflation is a pretty bold statement to say you're going to have both deflation and inflation after having all these years of stability. So basically the deflation begets the inflation because the policy that gets forced on our policymakers is so massive, and because of leads and lags, the reality of inflation doesn't come early. It takes 2 or 3 years to build up. They'll have gone too far with their policy in dealing with the here and now of a deflationary bust, and that money and that fiscal spending will be so massive that it will, with a lag, lead to, it'll jumpstart an inflation cycle that as it goes will just build upon itself. So, I'm talking about, and I don't think anybody else out there has these kind of numbers, but I think the potential is there for the Fed's balance sheet, which is currently, just over 7 trillion, to grow to 20 trillion plus in the bust. So if the bust hits later next year, you could have within a 12 or 18 month time horizon, the Federal Reserve balance sheet grow by 13, 14 trillion. And that's twice what it is today already. So, I mean, those are numbers that just are mind-boggling. We talk about trillions today in, kind of very cavalierly, but, trillions is huge numbers, and we're talking about multiple trillions and maybe tens of trillions. So that money will be sloshing around. And again, the Fed's going to be one central bank doing it. You'll see proportionally similar amounts coming from all central banks because it's going to be a global bust, never something that we've never seen before in terms of how fast and steep this thing gets. A bust means probably some major bank failures around the world. A bust means lots of dislocation and bankruptcies around the world. So, policymakers are going to be deer in headlights saying we got to do whatever we can. And we got a precursor of that in March, but this will be, multiples of that. So with a 2 or 3 year lag, inflation really starts building up. And I often say, look at the 1970s for a comparison. We went from low single digit inflation coming out of the 74 recession. And by 1980, we were looking at, double digit inflation and moving towards high double digit inflation. So it can build pretty fast. I think that's what the balance of this decade is going to look like, is deflation first. And then, 6 or 7 years of inflation starting to move up gradually and then really accelerating.
Now, if we look at what has happened since 2008, we've already seen trillions of dollars added to the money supply. So why do you think this additional, if we went from about 800 billion to, 7 trillion today, why do you see this extra 13 trillion really having any impact on inflation when we really haven't seen much inflation since 2008?
It's funny because if you had told me or anybody else back in 2009 or 10 that we were going to have that kind of an increase in money supply and not have inflation, and in fact be moving towards deflation, it would surprise all of us. I guess the simplest answer is you're going to have this much bigger, even as big as that was, a much bigger influx of money, and not just here but around the world, and so as big as that was, it's going to be at least twice that, and it's coming in a more concentrated period. It's not going to be QE1, QE2, QE3, QE4. It's going to be really one big massive QE that goes on for probably 18 months. But and I think the other answer, I guess, is that it's also going to be accompanied by I think some amazing magnitudes of fiscal spending around the world that's going to be geared towards infrastructure. And infrastructure, by definition, is going to demand a lot more use of commodities. So I think a lot of the inflation is going to be driven by commodities, and you're going to see labor will be demanded as well, because the economy is going to come back roaring. You put the two together, and I think you run into a situation where initially for the first couple of years of the recovery, it'll be low single digit inflation maybe, because you're moving out of a trough of, 3 or 4% deflation. So you probably in the first year out get into very low single digit, and second year maybe mid single digit. By mid-decade or just beyond that, you could be starting to approach double-digit inflation, and then it just goes from there. So, I just think the answer is that the money on top of money really takes us there.
Now, you've made the point that this inflation is going to have a big impact on precious metal prices. You're calling for 10,000 plus for gold and 300 for silver. Where do you get those numbers?
Sure. It really is just the expectation that the macro is going to be so dramatic that we've had 38 years of disinflation, inflation moving from 15%, 20% down to ultimately negative. You started moving back out in gold, in 2001, it moved from 250 to 1900. Spent 7 or 8 years in a consolidating pattern, and has just really begun to reemerge. Made a new high in the last year, and is really just beginning what I think is going to be a tremendous up leg. And if you combine the technicals with the macro fundamentals that say inflation moving to hyperinflation, it's in the gold and silver wheelhouse. And again, all metals are going to be moving up. All commodities are going to be moving up big time. I think agricultural commodities will be up strongly, and all commodities I think will be at significant new highs in history. I mean, they're going to have to work through overhead, et cetera, but ultimately, I think once they break out, you're going to see big moves up in all commodities, which is where the inflation comes from. And so, I wouldn't be surprised to see copper go to $12 or higher. I wouldn't be surprised to see oil. I actually have a call out there of oil going to $300 plus. And, natural gas could be $20 or $25. So you're going to see numbers in all commodities. But the thing about gold and silver is they are really monetary commodities, more gold than silver, but so they get that extra boost from that.
No, you mentioned how there's a possibility of even hyperinflation. I read this really interesting article, and I'd love to get your perspective on this because it made the point that essentially, if you look back throughout history in different hyperinflations, they often come along with kind of two other circumstances. So you see a supply shock, which causes, if you have the equal amount of demand but less supply, then prices will start rising. And then you also have the country that the hyperinflation happens in, the country has a lot of foreign debt. So in order to pay for their expenses at home, they have to print a lot of money because all the tax revenue is being used to pay off the foreign debt. In the US right now, we've seen a little bit of supply shock with respect to the COVID crisis, but I'm not sure that's enough to cause hyperinflation. And then also we have a lot of debt, but it's denominated in our currency. It's not in a foreign currency. So why specifically do you see this hyperinflation occurring?
Yeah, so hyperinflation, I'll use the 1970s because I lived through that period. I have the advantage over a lot of Wall Street that's, younger than I am and wasn't there. We had both what we call demand pull inflation and cost push inflation. So the demand pull is just what I was describing in terms of the commodity demand will be so strong it'll push prices up. You won't have the supply to meet the demand, and what gives is price. That's your demand pull, and it will be not just in commodities as we move through the cycle. It will be, car prices will go up, et cetera, because the cost of goods that are used to produce a lot of the manufactured goods will be going up. And then labor has to move up to keep track, to somewhat keep pace with inflation. It may not happen in sync, but with a lag, I think you'll see labor. That's the cost push part of it, is that, you get the cost moving up, you get the labor costs moving up. From a supply shock standpoint, I think that's going to be a huge problem going, it is a problem now. It's going to be an ever increasing problem going forward because along with the, 13 or 14 trillion in balance sheet expansion at the Fed, as I said, you can have a fiscal stimulus that's going to match that. So you're going to have, if we think debt is big now, global debt at 250 trillion plus right now could grow to 350 or 375 trillion by the end of the decade. Most of that front-ended, meaning most of it in response to the bust. So it would be the next 2 or 3 years after the bust where you see this huge, almost all of it sovereign debt. It's not going to be corporate debt. It's going to be really government debt as they try to pull themselves out of this big hole. So you're going to have funding issues because you already have funding issues today. Then you're going to boost the debt even more in these governments. And then think about that. If inflation's moving towards a double digit and ultimately goes to double digit, interest rates are also going to parallel that. And I really honestly can't tell you how that equation can work out. For a while they can print money and use it to fund to service the debt. But there's a point at which, and we learned this in the late 70s, where the Fed gets shut out of the game, because if you print more money, you create even more hyperinflation, and it becomes very rapid as you move up the scale in inflation. As you move into double digits and you keep printing money, it's going to go high double digits very quickly. And that's why Volcker was brought in the late 70s, early 80s, to basically go from targeting interest rates to targeting money, and he cranked down the money, and we had basically a double dip recession in 1980 and again in 82. It was necessary to try to wind out that hyperinflation that we saw. You're going to have that kind of thing, I think, except on steroids this time around, because the money we're talking is so much bigger. And keep in mind, industrial, at least in this country, industrial's been a much smaller part of the economy. It's been really a consumer economy for the last 3 or 4 decades. I think you're going to see a return more to an industrialized recovery, something we haven't had since the 1970s, and not just here, but around the world. And that again is much more commodity intensive, material intensive. So that is, I think, the shock. I don't really think the inflation is driven by money ultimately. Sometimes the lag's not always predictable, but that's the real shock, is the massive money that's going in.
Speaking of the hyperinflation and getting back to precious metal prices, I wanted to ask you a question, but just kind of to put things in perspective, I have some of the notes from the German hyperinflation. I'll get them just 1 second here. Here's a 25 milliarden mark note. So that's actually, milliarden means billion. So that's 25 billion marks. Everyone can see 25 milliarden. So essentially, if we see that kind of inflation, I mean, is that the kind of inflation you're looking for? And then when it comes to gold and silver prices, it seems like, the sky's the limit. And what meaning would actually a price on gold and silver even have if we're going to see that kind of inflation?
Yeah, I'm certainly not talking about, the Weimar Republic or Zimbabwe type inflation, or even, Venezuela type inflation. That's where they're just running the printing press full out, and there's no central bank control over it or anything. I don't think, certainly I can see the potential for us getting back to a 20% number, which is kind of the peak we saw in 1981. I would say maybe there's probably, given the magnitudes of this, a chance that we could really exceed that and see 25% or something like that. But these situations where you go to buy a loaf of bread and it's now quadrupled in the last hour, and you don't have the money because prices are moving up that fast, we're not going to see that kind of stuff. I don't think you see wheelbarrows full of money to buy a loaf of bread. It's not that. But believe me, 10% is going to be very hard. 20% is going to be obviously a lot harder for people, because wages don't keep up. That all kind of happens. So they'll put in indexes and things at the end of this to try to, price boosters, try to keep them so if prices are moving fast. But it's not so much that it's moving minute by minute like that. It's much slower than that. But it's if you get into double digits, especially with the debt we have today, it can't last very long because we can't service it. There's going to come a point, I think, towards the end of this decade, where we're not going to be able to service our debt. We're going to lose access to the capital markets one way or the other, because the U.S., which is always looked upon as, the country of discipline, where you're going to get your money back, when you're struggling to service your debt, all of a sudden you're not looked upon as the Cadillac out there. And I do think that's the real awakening for this country. Everybody wants to point at the Fed as the blame, or certain government policies to blame, but the reasons we're in the place we're at in terms of having such massive debt is because everybody chose to live for today and say, oh, I can borrow money, I can, max out my credit card, I can buy a house that doesn't really fit my income because I know I'm going to be able to flip it later or what have you. We've all been guilty, or certainly most people have been guilty for decades of living, taking money from tomorrow to live for today. And the government's been, the extreme of that. But now we're going to run into a situation where when there's not ability to fund that debt, or at least ability to go issue more debt because you've gone off the reservation with the amount of debt you did to pull us out of the trough, you're going to have a situation where we finally in this country find out there are limits. If you have a national emergency, let's say a hurricane, where did that money come from? Some of it was budgeted, but a lot of times we just issued more debt to say we need more funds. Every year we raise the debt limit, as if it's just no problem. And now, as you well know, we have people talking MMT like you can print money forever and it doesn't have consequences. No, there's going to come a time when the Fed is shut out of the markets. The Treasury is shut out of the markets and the Fed is unable to keep printing money. When those days come, and they're coming this decade, all of a sudden your standard of living is going to drop dramatically because you can't, the only reason we've been able to sustain this is because we kept growing the debt and the money. And that's what I think is coming by the end of this decade. So there are a lot of gloom and doomers out there that would tell you we're at that point now. The difference between me and them is that I say if we're heading for deflation, the Fed has, and the central banks around the world have virtually unlimited ability to print money in this short period of time in the next year or two, because there's no inflation, there's actually deflation, let's say, and the inflation consequences of that rapidly printing money come with a lag of 2 or 3 years. So they're going to face, they're going to be facing bank failures and all kinds of unwinding in the economy, a lot of dislocation. They're going to focus on that and not worry about what's going to come 2 or 3 years from now, because they're not seeing it. They're seeing the prices dropping. When the finally catches up with them, it's too late. It's already built into the system. The inflation's starting to run away. And at some point, like I say, then your central banks are out of the game. And there's, that's why I laugh at MMT. It's not a real thing. I don't consider what we're doing now MMT, but I understand people thinking this is the start of MMT. I think what we're doing now is what we've done during every recession, which is, try to stimulate the economy with both fiscal and monetary expansion. And that's fine, except that we have ratcheted this thing up now to where, we're in the theater of the absurd in terms of the amount of money it takes to do that now, or the amount of debt that we're issuing. But MMT, if you want to call it MMT, it's going to be very short-lived.
Now, before we let you go, I kind of wanted to address, if people are, hearing this and thinking, well, this is a possibility of higher inflation and all of that. And, but first a stock market crash and everything. What is your perspective on prudent steps people can take to kind of prepare for this occurrence, should it happen?
Yeah, I can't, as a strategist, I forecast. I'm not really allowed to provide advice, and I'd say that's kind of providing advice. What I will say is, obviously, if I'm right, we're late in a long-term secular bull market, and what people should be aware of is that, going forward, we may not see anything wherever the top is, and I think the top happens first half of next year, probably first quarter of next year. Wherever that top is, we likely won't revisit that top again I'm talking about the broader stock market, for perhaps decades. So if that's true, so let's say we get to 4,500 on the S&P. If we then follow that with a big bear market that takes us down 70 or 80%, you can come out of that bear market and even triple your money. Let's say we do go to 1,000 on the S&P. You can triple your money and only get back to 3,000, right? And if 4,500 was your top. The thing people don't always understand is that markets, the big secular bull market that I say started in 82, the reason I date it back then is because of disinflation and rates peaking out in that time period and ratcheting down over 4 decades. We're going to have the reverse of that, where rates bottom out in the next year and begin ratcheting up towards double digit and then high double digit. The value of the stock market is 2 components: earnings and the capitalization of those earnings, meaning the price earnings multiple. So if rates are moving up, multiples move down. If rates are moving down, multiples move up. So for the last 38 years, you had rates generally trending down and PE multiples moving from single digits back in 1982 to now they're mid-20s, or at least over 20. So you're going to have the reverse of that going forward, say from 2022 to 2030, where if you go from negative interest rates or 0 up to potentially 15, let's say 15% on the long bond or the 10-year, what's the multiple going to do? It's going to shrink. So I would just say that would be the thing I can point to, is people should be aware that what we've had for many years, and actually decades, is not what we're probably going to see going forward. You're going to have a situation where PE multiples are going to be shrinking. That being said, being in things that are going to benefit from inflation as opposed to things that are hurt by inflation is going to be important as well. In a period when interest rates and inflation move down from high double digit to 0, you basically see growth stocks do very well. In a period when you have inflation going the opposite direction in a big way, it's the commodities and those things that have pricing flexibility that do well. So gold, silver, copper, oil, and like I said, the ag area is probably going to be very good. From a real estate standpoint, probably the area that will benefit the most in the environment I'm describing will be farmland. The farm belt will be in their heyday because you're going to see corn prices, wheat prices, soybean prices move, and cattle and et cetera, I think move through the roof over the course of the decade. So those will do well. The areas that were more growth oriented, meaning the coasts, may have a real overhang because they were more consumer driven, technology driven. So it's those kind of things that can, I think if you think about it, can make a difference in your portfolios.
Well, David Hunter, thank you so much for your time today. Before we let you go, any last thoughts you'd like to add, and where can our viewers find you online?
Sure. I guess the one thing we didn't address is bonds. And I would say, I think interest rates probably, they're in correction mode now. I've been talking about this for the last few months. So the 10-year Treasury rate can get back up towards 120, 130, maybe even as high as 150. And then I think in the bust, it'll go back down and you'll see your final low in rates. The rates have, as I talked about, have dropped for almost 40 years. You'll see your final low in rates probably sometime next year, mid-year, maybe sooner. And then I think because of inflation, you'll basically retrace almost 40 years of rates falling and get back to that 15% long bond and 20% plus Treasury bill by the end of the decade. So that doesn't speak well to bonds, and so people should be aware that we've had a very unusual, huge secular bull market, not just in stocks, but also in bonds here in the last 39 years. And that's probably going to come to an end next year, which means, what's coming on the bond side is also going to be very different than what has happened already in the last, 4 decades. As for where to find me, I'm on Twitter. My handle is Dave H. Contrarian, so at Dave H. Contrarian. And I also put out a investment letter that anybody, it's by subscription, so it's not free. Anybody that's interested in it can reach out to me by direct message on Twitter.
Fantastic. Well, David Hunter, thank you so much for joining us today, and God bless.
Thanks, Elijah. You too.